Robert Sokin is global economist at Citi. He's joining us right now to take some questions. Robert, great to have you with us here. Thank you very much for your time. So, are you would you side with that last view that maybe now things are the Fed will see the softer inflation and indicate a downshift and perhaps a pause early next year? What's your sense?
Well, thanks so much for having me. And I think for the Fed, you really have to look at the universe of inflation data that we've had over the last several weeks. And to me, that universe still paints a very mixed picture. On the one hand, you had core goods inflation coming better than expected today. That's 2 months in a row of fairly good core CPI prints. You also had data from the New York Fed on inflation expectations that showed broad-based month-over-month improvement. So on that side of the ledger, you're seeing some progress on the inflation front. But on the other hand, if you break up, I think it's useful to break up today's core inflation data into three categories: core goods, shelter services, and non-shelter based services. On the core goods side, you're seeing a lot of improvement. That's really been driven by supply chains easing over the last several months, and you have very much reasons to think that that's going to continue. On the services shelter side, those numbers are still running hot, but if you look at alternative measures of rental prices, if you look at the softness in the housing market, you can be pretty confident that those data are going to start to improve next year. It's that third bucket where the real risk is and where the real uncertainty is. And for me, there's still a fair amount of upside risk in that non-shelter services category. Overall, the number was pretty good today, but you still have a lot of categories like education, recreation that are running at very hot inflation rates. And that non-shelter services bucket tends to be very tightly tied to the labor market and very tightly tied to wage growth, because wages tend to be a large portion of these businesses' costs. When wages are rising, they tend to pass those on to consumers. And if you look at the Atlanta Fed wage tracker that came out last week, which is one of the better measures of wages that we have, it showed very broad-based wage pressures across industries with very little, if any, sign of subsiding. So I think if you're the Fed, you still have to be worried about upside risk to those non-shelter services. And so I would lean more on the Fed still needs to strike a hawkish tone tomorrow, given the upside risk to inflation, particularly in these non-shelter service categories.
Okay, so there's a hawkish tone coming up tomorrow along with a 50 basis points rate hike. Robert, good morning. I guess this is something that global equity markets or risky assets have already priced in. The big question is, what is the way forward post the policy tomorrow? Do you think it's fair to assume that the Fed may be one step closer to halting interest rate hikes or perhaps even switching to cuts? And eventually, that's something that can fuel equity markets. Your thoughts?
I think, as you said and others have said, tomorrow I think is fairly baked in, a 50 basis point hike that's been very well telegraphed. I still think they're going to lean hawkish tomorrow, and it's too soon to say whether they can start to think about pausing or starting to think about even cutting. I think what's clear is, and they've made this clear in recent Fed speak, is they want to slow down the pace of hikes. But I still think it's likely that they're not going to be committal on where the terminal rate and the risks around there are ultimately going to go. I think the dots tomorrow are going to still show a 50 basis point increase relative to September, so it's going to be above 5%. And I think they're still going to say that there are risks there that could go even higher than that. There are also risks that could go lower. It depends on how the data evolve. But I think in terms of thinking about whether they're going to stop after the next hike, I think it's too soon to say. I also think that once they get to that terminal rate, whether it's under 5, whether it's above 5, I think one thing that's underappreciated is that they intend to hold that rate there for a material period of time. So in our baseline forecast, we have them going to 5.25 to 5.5 next year, and then holding that rate throughout the entire year, because they're really going to want to see continued progress on inflation moving back to target. So, I think there's two debates here. How high are they going to go? I think there's still a lot of uncertainty around that, and how long they're going to hold the terminal rate. And I think the idea that they're going to start cutting very quickly is still premature at this stage.
So higher for longer, and your estimate is that the terminal rate goes all the way to 5.25 or perhaps even 5.5. Robert, morning. So what is your rate hike trajectory? The next policy is going to be in February. Do we continue to expect a 50 basis points, or can they bring it down to 25 basis points? And I know it's too soon to talk about a cut, but what about a pause? When do you think Fed can start pausing on rate hikes? Your own assessment.
Absolutely, yeah. So we have 50 basis points at the meeting tomorrow. We still have them doing another 50 basis points in February, and then followed by 225s for them, with the last hike being in May. I would say, following this inflation data, the risks are that instead of doing another 50 in February, that they slow down the pace to 25. But that being said, I still think it's too soon to say whether they and when they're going to pause that hiking cycle once they get to 25 basis points, because they still have these upside inflation risks. They still need to see inflation moving decisively to target. And so I think, relative to our call, I'd say there's a good chance that they slow down to 25 in February as opposed to the 50 in our base case. But I'm still pretty comfortable, given these risks I mentioned around inflation, that they likely have to move above 5 and likely, 5.25 to 5.5 range. So I think this inflation data, if anything, puts the risk on the table that they slow down again after this meeting. But I still think the risks are that they, keep going with hikes into the middle of next year.